A lot of investors are skeptical about investing in any type of retail stocks. There are two in my portfolio, both retail real estate stocks that I have no plans to sell that recently reported earnings. And to be fair, it's a mixed bag. We'll get into the numbers in a second. For the moment, please take a minute and check out the link you see on your screen for a message from my sponsor, The Motley Fool. It's the best way to support the work I'm doing on my YouTube channel, and you get the top 10 stocks to buy right now. So we are seeing some headwinds in the retail space. Demand for retail or for just getting out to the malls and things like that just surged after the pandemic. There was a lot of pent up demand. We're seeing that really calm down, especially with the recession being projected. A lot of consumers are hesitant to spend money, especially borrowed money. People are putting less money on their credit cards, which I guess is a good thing, but not if you are a mall owner. So we're seeing some of that reflected in earnings. One of the stocks I own is called Simon Property Group. They're the biggest mall owner operator in the world. Ticker symbol is SPG. And for the most part, the numbers look pretty good. Occupancy at Simon's properties was up 80 basis points year over year. That's 0.8%. And it raised its base rent by 3.1%. That's not affecting occupancy, so that's a very good thing. But we're seeing a little bit of a decline in earnings. Funds from operations, or FFO, which is the real estate equivalent of earnings, was down about 1% from where it was a year ago. The real estate is doing fine. The malls produced net operating income that was 3.7% higher than in the second quarter last year. There are some negatives. Simon bought a bunch of operating businesses in the past few years, essentially acquiring retailers out of bankruptcy along with partners. Forever 21 was a big one. JCPenney. A lot of the businesses it bought aren't performing quite as well as they hoped. So that's been a little bit of a drag on the business. But Simon's business, the mall business, is the vast majority of its revenue, and it's doing just fine. The company is very financially flexible. They have $8.8 billion of liquidity, including $1.4 billion of cash on the balance sheet. That's a lot for a real estate company. So Simon's very profitable. They gave investors a raise. They increased their dividend again to $1.90 per share per quarter. That translates to about a 6.5% yield, and it's well covered by earnings. So earnings could take a hit, and they would still be able to keep that dividend up. But again, not everything's great. At the end of the first quarter, Simon's retailers were reporting $759 in sales per square foot at their properties. That's down to $747. So retailers are reporting that sales are calming down, consumer spending is taking a hit, and its net operating income growth at its properties was a slowdown compared to the first quarter. So not everything is great, but overall a pretty solid quarter, and the stock looks pretty attractively valued right now. Other stock I own is Tanger Factory Outlets. Ticker symbol is SKT. They're the second largest outlet operator to Simon. Simon owns the Premium Outlets brand. Tanger operates under its own brand name. They have 37 properties in the U.S. with one more on the way. The Nashville Tanger Outlets is set to open in October. And the numbers are looking very strong. Their occupancy is 97.2%. That's higher than Simon's. They're getting 13.2% rent spreads on new and renewal leases, and that's fueling 6% same-store net operating income growth. Very, very attractive. And we're not even seeing the higher rental environment being priced into the stock yet, because 49% of their leases are expiring between now and the end of 2025. Just like Simon, its tenant sales are down slightly. They're down 1.3% year over year on a per square foot basis, just in line with Simon. Nothing to be totally alarmed about yet. That's to be expected in an environment like this when you're expecting a recession. Interest rates are rising, things like that. Like Simon, they have a high liquidity amount. They are a much, much smaller REIT, but for their size, $200 million in cash and an untapped $520 million credit line is pretty impressive. In both cases, management just keeps executing on growth strategies and getting properties leased up. And I'm a buyer on dips. I haven't added to either position in a little while, but they're definitely on my radar right now after these earnings. Tanger still trades for less than 13 times earnings and has a 4% yield. Simon is even cheaper with a 6.5% yield. If you're looking for high dividends and don't mind kind of waiting out some economic turbulence, these two stocks could be worth putting on your radar. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by the Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.